We have a panel here that will hopefully enlighten us both on the global subject, but also as it relates to Greece and our region. And to my left, we have Mr. Lee Cumbes, Head of Debt Capital Markets and Public Sector at Barclays. Mrs. Myriam Zapata, Managing Director, Debt Capital Markets and Sustainable Finance ESG at BNP Paribas. Mr. Christos Christodoulou, Executive General Manager and Group CFO at the National Bank of Greece. Mr. Antonios Timplalexis, Managing Director and Regional Head at Nomura. And Mr. Dimitrios Tsakonas, Director General of the Public Debt Management Agency. I wanted to start with Myriam. What are the 2-3 main trends in ESG and international financial markets these days, and how far will ESG agenda go in the world of finance? In addition, while you're on the question, how have market conditions affected the ESG agenda in the financial markets?
That is an easy question, I guess, and short as well. Yeah, you want to?
Very good, and Nick Bornozis would love that.
So I would say that it depends on the main topics and themes in ESG. It depends whether you're looking at the bigger picture, whether you're looking at products. On the bigger picture, I would start by saying that regulation is making a big impact in how ESG discussion is going. In Europe, who is leading the charge on ESG, we have now regular market regulation telling asset managers, for instance, that they need to offer the possibility, or they need to ask proactively the question to their end investors whether they want to invest in sustainable funds, whereas before that wasn't necessary. And of course, when you do that, then you do need to define what is a sustainable investment. The regulation is not telling you what a sustainable investment is. So that's one of the main things in market regulation. But then we have the whole new sustainable finance regulation, which is forcing investors to disclose. It's forcing them to disclose what the level of sustainability in their funds, in their plans, in their strategies, and to classify their investments according to a dark green, a light green, or a non-green. And all of that is creating a lot of confusion. It's creating a lot of work, but on the positive side, it's creating a lot of data that didn't exist before. So that regulation is focused on combating greenwashing, clarifying, and also creating that data. Once corporates start producing that data, investors will be able to provide that data to their end investors. And of course, for issuers of sustainable financial instruments, that is very useful. If you have an investor who is in the need of disclosure, because they need to disclose it themselves to the regulator, they will start looking at issuers of, let's say, green bonds or sustainability-linked bonds who can give that data themselves. So they will look at impact reports and say, yeah, I get a lot of data here, so I will invest in this. I think there is a lot for Greece to do here, and for Greece issuers of sustainable finance instruments to lead in this, in this very important task, because we are only at the beginning. So I would say that that's the main topic. And I don't know whether that was the...
I think that covers us very well. Thank you so much, Myriam. Lee, from your perspective, what are the key trends at present affecting the debt capital markets, and especially the sovereign debt market globally and in Europe? And can you comment a little bit more about Southern European countries, especially if you can zero in Greece, or Italy, Spain, Portugal?
Sure. Thanks for the question. Thanks for the invite to the panel. I'll talk a bit about the influences, perhaps, on the markets and sovereign markets. One of the things is that there are many different factors at play here. We're coming out of a market for a number of years that's been dominated by the central banks, reducing volatility, creating predictability. And we have a multitude of different factors, but maybe I'll talk about three. Two of them very obvious by now to people. The first one being the return of inflation in a scale that we haven't seen in decades, and therefore outside of the living memory of markets, another important point. That's not just investors dealing with that, but central banks dealing with that return in inflation, obviously raising rates at a level and an aggressive pace that we also haven't seen for decades, again, outside the living market memory. And thirdly, perhaps the one that we haven't talked about too much, and I'll spend a bit more time on, is the return of net supply. Very large still government funding needs in the absence of QE means that we will have to find true private sector investors to buy and hold those bonds. And that's something that we haven't done in a significant amount of time. Since 2014 in the Eurozone, since earlier than that in the US and the UK. And by the way, how those three things, or even the multitude of factors, how they interact and interplay and affect each other from day to day will change. We're working into a market where we'll have to be very flexible, adaptable, informed, because we have not seen these sorts of forces on the market, and how they all combine is also another sort of variable here. But get back to the point on net supply. Clearly that's changed. We're expecting hundreds of billions of supply in the Eurozone on a net basis, given the absence of QE next year. That's, again, as I say, the central bank will not be soaking that supply up. It will be private sector investors with a very different approach to the market, life insurance companies, pension funds, banks, hedge funds, who have an entirely different way of pricing that risk to the ECB. And the price sensitivity is different, or the price insensitivity is different. And again, having an understanding of those private sector investors, what they want to achieve, having a deep dialogue with them, and a way of understanding their needs and how to make a debt market attractive is really going to be key. It sounds so simple almost to be untrue, but I think the simple messages in a complex time are what you need to cling on to and have some sort of strategy and have some principles around your strategy. Listen, to get to the point of the question, given the conference that we're at, and focusing on Greece, I see strengths in a country that was perhaps potentially or arguably the least affected by QE, the least reliant on QE over the course of many years. I see a debt office that spent a vast amount of time making themselves truly expert in attracting private sector investors to a scale that perhaps hasn't been the case across the rest of Europe. And I see a market at interesting yields. When I talk about private sector investors, they need to be compensated for risk. And I think arguably the Greek market has moved to an extent that hasn't been replicated across other Eurozone government bond markets. So we need to offer people opportunities, and looking at yield levels now, where they were versus only January of this year, we've moved at a significant pace. And perhaps just to wrap up, in the last couple of weeks, we've had a huge burst of syndicated bond issuance, a record November actually, 150 billion out of Europe, similar numbers in the US. That gives you a sense that private sector investors are ready to move. And I think that we have an optimistic foundation here to move ahead with Greece, arguably against some of its closer peers.
Great. Thank you so much, Lee, for your answer. And I would have to say that, Greece is not had not been as dependent on QE, but I think that's also unfortunate. We were holding an umbrella while money were raining down. And I guess this leads to a question for Dimitrios, who heads the debt management office. Dimitri, can you please summarize for us the key trends for 2022 in relation to Greece's sovereign debt management, and help us understand or explain your philosophy and objectives for 2023?
Yeah, thank you very much, Antonis. First of all, I need to stress that so far we have achieved all of our targets as far as the funding strategy and the portfolio management strategy is concerned. Especially, we need to take into account what comes next in the volatile interest rate environment in the capital markets, the increasing inflation, and therefore the increasing interest rates. I need to remind you that a year ago, according to the plan that we have presented through our funding strategy, the funds that we wanted to, let's say, to raise from the capital markets in order to cover gross financing needs for 2022 was approximately 12 billion. So far, we have raised 8.3 billion. And I need to stress that we were done since April as far as the funding strategy. Why we reduced, or why we were able to reduce the funding activity by approximately 4 billion for this year? Because of the positive surprise, the positive outcome as far as the real and the nominal GDP growth, i.e. the inflation in combination with the real GDP growth. I need to remind you that according to the initial assumptions for this year, the real GDP growth should be in the order of close to 10 to 12 billion. The final outcome will be close to 30 billion. And in order for you to make your own calculations, you need to use a simple rule of thumb. For every 10 billion of additional nominal GDP increase, the tax revenues are increased by 3.5 billion, the one-third, out of which two-thirds has to do with the indirect tax, i.e. VAT, and the other one-third has to do with the income tax. So by having a positive surprise of more than 15 billion, according to the initial assumptions, you may understand that we now can say that we have more than 5 billion of tax revenues. That's why we were able to reduce the funding strategy by 4 billion compared to the initial assumptions on the funding strategy for 2022. Now, for the next year, because everybody is keen to hear this, let's say, the strategy for next year, it will be publicly available in a couple shortly after the ratification of the state budget by the Greek Parliament by the end of this year, 20th, 21st of December, most probably. During the Christmas Eve, the present of PDMA to the worldwide, let's say, to the universe, will be the next funding strategy. But let me give you a flavor of this funding strategy. 7 to 8 billion, not more than this, and in this amount we need to incorporate also the possibility to issue a green bond issuance. I need to stress that we have already appointed a bank, one of primary dealers, is BNP Paribas, almost a year ago, to play this role or to have this role of the structuring advisor for a green bond issuance. I'm going to revert on this issue. So why 7 to 8? 7 billion has to do with the amortizations of next year. I need to remind you that initially the original amortization profile had to do with 11 billion, but again, due to the prepayment of the IMF loans and the upcoming early repayment of one big chunk of the GLF loan, close to 2.7 billion that have to do with amortizations of next year, 4 billion of the original amortizations have already or will be prepaid within this year. So the gross financing needs will be deteriorated by this amount. On top of the 7 billion remaining amount of amortizations, we need to add 4.6 billion of interest payments. Let me take the opportunity now to tell you, and please, once again, I need to remind you, because, you know, consistency for us is key element of our, let's say, operation. 2 years ago, the annual interest payments were 5.7 billion. Last year was 5.2 billion. This year will be 4.8 billion. Next year will be 4.6 billion. Please don't put a bet with me. In 2 years' time, it will be even lower. In the upcoming 5 to 10 years, most probably, we will have a stabilized amount of much less than 5 billion, will not exceed, in any case, the 5 billion, close to the lower, let's say, to 4 billion, something between 4 and 4.5 billion. This has to do mainly with the portfolio management strategy that we have done so far. And I need to stress and to remind myself, first of all, and to you, that the solidarity that has been provided so far by the Eurozone partners, i.e. the short, the medium, and the long-term measures, debt relief measures for the Greek debt, reassure us that most probably for the next 20 years there will be no nasty surprises as far as the servicing cost of the Greek public debt is concerned. So 7 billion the amortizations for next year after the prepayments that I mentioned before, plus 4.6 billion the annual interest payment makes 11.6, minus 1.5 billion that will be most probably, and this is a conservative assumption, the primary surplus. This gives us as an outcome 10.1 billion. We have decided to provide on top of other elements, a positive surprise both to rating agencies and to investors community. Next year, or at least this will be the effort and the target, the outstanding amount of our debt will be stable and equal. This is the effort, this is the target, with this year's year end of 2022 outstanding amount that will be most probably in the area of 355, 356 billion. So we want to provide an additional positive surprise because indeed for us and according to our baseline scenario, the investment grade status will be achieved by the end of next year after having leaving behind the elections. That creates uncertainty. There is no political risk in Greece, believe it or not. Whichever will be the political party, most probably we will continue implementing structural reforms as they have been decided between the Greek, the Hellenic Republic and the European institutions. So there is no political risk, but there is political uncertainty because if you need to achieve a fiscal consolidation of approximately 5 billion, minus 3.5 billion this year, to positive 1.5 billion next year primary surplus, and I'm referring to the fiscal number, then you have no time to lose. You have no time, let's say, to lose 2, 3, 4 months just trying to find, let's say, the new government. So there is a political uncertainty. I think that everything will be in the end in the right way, in the right order. So this is the first that we need to leave behind. But on the other side, we need to provide, as I mentioned before, positive surprises, not only providing or showing that the Greek debt is in a falling trend in relative terms as a percentage of the GDP. It seems that now this is a piece of cake for us, but still we need to stabilize the number, i.e. the outstanding amount. So in this context, 7 billion will be more or less the funding activity for next year. And last but not least, because this is the subject of this panel, we have to face a severe risk as far as the GGB market is concerned, and this is the liquidity, the lack of liquidity, which one way or another should be resolved. I need to be honest, as always, with you. This problem cannot be resolved in a blink of an eye. It will take time. I need to remind you that a decade ago, more than a decade ago, we used to be a sovereign issuer with an outstanding amount of debt similar to the today's level, 365, out of which the two-thirds, 265 billion, used to be what we call tradable debt. At that point of time, we used to have a liquid secondary market. Now, after the imposition of the PSI, after the debt buyback that took place in December 2012, now the outstanding amount, even if we take into account the, let's say, the funding activity that we had the last 3 to 4 years, unfortunately, the tradable portfolio is close to 85 billion. I don't want to analyze, but only or even less than 5 billion is the free float, because the PPP was a valuable contribution, or had a valuable contribution as far as the funding activity of the Hellenic Republic. On the other side, created a side effect of the lack of liquidity. So what we are going to do for the upcoming year, recently, and thanks to my political supervisors that they bought the argument, the new law for the operation of the PDMA was ratified by the Greek Parliament. It was on June 16th. According to this law, now the PDMA has the opportunity to issue over and above its funding strategy securities, and these securities being the PDMA being able to keep them to its securities account, to its portfolio. This element will provide us, these additional securities will provide us the opportunity to get into or to introduce a kind of a repo facility, mainly addressed to the primary dealers of ours, in order to provide a way out to those that are trapped by accident. We are not going to facilitate those that they want to make profits due to their short positions. On the other side, somehow we need to facilitate the secondary markets operation. The next step, or the next, let's say, facility that we are going to provide, I need to remind you that this year we introduced on an ad hoc basis, I need to stress, auctions in order to provide additional supply to inject with supply, let's say, specific maturity points across the maturity spectrum that we have realized that there were distortions at that point of time. Now, this will take a more regular format, i.e. we're going to establish on a regular basis a communication with our primary dealers on a monthly basis, most probably. We're going to announce on a monthly basis an auction program, but I need to stress the decision, the final decision, if we need to proceed or not to proceed with an auction, it will be based on our sole discretion. So everybody will be in a position to know that once a month, most probably an auction is coming, but the final decision will be taken a couple of days before, based on the appetite of our primary dealers, the information provided by them. My last point, because I think that I took a lot of the time, but my last point should be the following. We don't really care about the interest rate environment. Why? Because we have plenty of cash reserves. I need to stress that when we are talking about of zero cash reserves, we mean 25 billion at least. So I need to reassure you that there is no possibility Hellenic Republic not to meet its debt obligations under any circumstances in the upcoming years. And secondly, because we are overhedged as far as the interest rate exposure is concerned. The combination of these two elements provides us the possibility either to issue at the levels as far as the funding cost is concerned that we used to issue 2 years ago, less than 3% for weighted average maturity of 10 years, or not to issue at all, i.e. zero funding costs for the next 4 years at least. So this is my optimistic approach, which is, to be honest, a conservative one. The best is yet to come, as always. This is my last statement in these panels. And believe me, please check my consistency in a year's time once again, if we will be in a position at that point of time to say that we delivered or not. Thank you, and sorry for taking your time.
Dimitri, actually you didn't, because you asked question number 2 and number 3 that I had. So thanks for the comprehensive answer. Most importantly, thank you for the impressive and tireless efforts to further de-risk the Greek sovereign, which is very impressive, and I think they should be recognized. Now, Chris, you sit on both sides of the balance sheet at the National Bank of Greece. All bank CFOs have a unique perspective. On one hand, you have the clear view of what is happening in the real economy through the bank's lending operations in real time. On the other hand, you're tasked, among other things, with raising and managing liquidity for the bank so that the bank can operate and function. You're a borrower, you're a lender, and in both cases, a very sophisticated one, with real access to a lot of information. Against that, what is happening in the money markets in Europe in general, and in Greece in particular? Is liquidity diminishing, and what is the outlook for borrowers and investors as we go into 2023? And I know it's a long question. Hopefully, you'll give us as brief of an answer as possible.
It's a short answer.
Because I'll be chased down.
Yes, no. From the perspective of banks, indeed 2022 has been a very challenging and volatile year for the money markets, both in Europe and in Greece in particular. So we had the war in Ukraine, we had the increase in energy prices, we had the rocketing inflation, which along with the overall macro uncertainty did not help at all. Neither investors nor borrowers like uncertainty. Now, as a result, we've experienced a slowdown in the money markets for the best part of the year. However, we've seen an improvement in the conditions towards the end of the year in the last 4 weeks. It was mentioned before as well. We've seen that in Greece as well, with all 4 banks taking advantage of this window of opportunity and coming out in the market for debt issuances. So I think we are finishing 2022 with optimism and entering into 2023 with this momentum, positive momentum, despite the fact that it's an election year, as Dimitrios said. Nevertheless, the dynamic seems to have to improve compared to what we've experienced in 2022. Now, on a more positive note, in terms of liquidity for the banks, I can assure you that all 4 banks and the banking sector in general is quite well in terms of its liquidity position. Both 4 banks operate with very healthy loan-to-deposit ratios, well below the 100% mark. The stock of deposits has been growing for both corporates and households for at least the last 3 years. Year to date, this year, we are up by about 8 billion, more than 8 billion of deposits year to date, and the expectation going forward in 2023 is again for an increase in the level of deposits in line with nominal GDP growth. We at National Bank of Greece, I think we're sitting very comfortable in terms of our liquidity position. We have a significant excess cash balance, even after the recent change in policy from ECB with regards to the TLTRO facility. In fact, we have early repaid 2 billion of our TLTRO programs in November, and we have another 1.5 billion of repayment coming up by the end of the year. All in all, our original TLTRO balance, to give you some perspective, was 11.6 billion. So to that end, liquidity is at good levels with the Greek banking sector. Now, another thing that we need to mention is the cost of money, the cost of funding. Rates have been going up. Inevitably, the cost of funds has gone up, and that has affected significantly already the cost of issuances. As you saw this year, the cost of issuances has gone more than double from what the banks were issuing last year, not just in Greece, but in Europe in general. And to finish off this first question, we've already started to experience the increase in the cost of funds in deposits as well. I don't know if you follow closely the Greek banks, but all banks have now started to change policy, and you've seen us spiking up the time deposit costs in the last 4 to 6 weeks. So that's where we are as a system.
Thank you, Chris. Andoni, what does the international capital market environment mean for your Greek clients in Greece as you see it? And do you see opportunities in 2023? How will Greek issuers adapt to what is likely and admittedly a harsher economic environment?
Yes, thank you. I guess, we heard Dimitrios, obviously. I'm not going to spend time on the sovereign. I think that we're very prudent, going very early this year. So I think, as he said as well, it's not a matter of where the market is. Frequent issuers need to issue, and they will issue when there are windows. I mean, if we take a step back and talk about the corporates, I guess, which they're not represented here today, and I guess the reason is that they haven't made any issuances this year. But to be honest, that wasn't the problem. The banks, as Christos said, they're very liquid. They pretty much filled the gap there. Now, on the FIG side, on the financial institutions, I think Christos was a bit modest. I would say that all of them, including NBG, did a fantastic job, because during the year was very challenging, as we'll know. We talked about it already. Inflation, growth not going great outside Greece, but also Greece probably is going to be a bit challenging, in the next few quarters. But when the windows were there, pretty much all the banks had done the homework early. They were meeting investors early. They were ready to go. And I think, if I'm not mistaken, on the count, we had something like 7 transactions happening in a matter of weeks. I think from NBG as well. Again, if I'm allowed by Christos, I'll say they were impressive. They opened the market on the international side with a proper international bond. Then, we show a GBP issuance, British pound, which we haven't seen for a decade plus, coming from a Greek bank, and also private placement. And that's also from, the same happened from the other banks as well. Alpha Bank did 2 issues now. Eurobank had a tier 2, all very well placed. Piraeus Bank, the same. So I think, the advice, obviously, and, our clients are pretty much frequent issuers and most of the times know what to do without even us advising, is to be ready and when the window is there to prudently go on the market and print transactions at elevated levels, but that's what the market is, so you need to do that. Liquidity is not a problem, as you know, for the Greek banks. They need to issue MREL. They need to issue for capital perspective. So, they need to follow the regulator guidance. So they will do so, and they've been doing so. With regards to the next year, and I guess we're all hearing here, it's not going to be an easy year. Is maybe for the issuers to be ready, as we said, but also, there's a trade-off, and Christos will probably refer to that as well, of going early in the year or waiting for maybe the market to be calmer or the environment to be better or the cost not to run its course. But again, our advice would be to target early windows. When you have them earlier in the year, you go ahead and you print. It's not a it's a marathon, let's call it, and a long game. So at the end of the day, sometimes you will issue at the better conditions, sometimes at worse conditions. But at the end of the day, it's good to take the risk, if I may use the word, out and go earlier rather than later. So that's all from me.
Thank you so much, Andoni. Myriam, when discussing with clients, what are some of the alternative source of liquidity that you're putting on the table or offering that, or that you see that are available at this point?
Well, I think that in sustainable finance, the main source of liquidity at this point, with all the products that have emerged, it's still the green bond. I think that Dimitrios was referring to it. Some of the sovereigns in Europe right now have that issue with the green bonds, with the instrument that was providing the most liquidity. And just to step back a little bit, the growth of the green bond market ballooned at the time that the sovereigns decided to enter that market, because they provided that critical mass. They basically send the message out that if the sovereign is issuing a green bond, they will be able to provide a certain size, and therefore investors can up their commitments to sustainability. An investor is not going to commit 2 billion, 3 billion of investments in green if they don't see that they will be able to source the assets. So this market ballooned when the sovereigns entered that market. And so their contribution, even if they were a little bit late into the game, was really to provide that level of liquidity. So at this stage, I would say that it's still the green bond product that provides that liquidity, but I do concur with the fact that we still have a lot of work to do and some headwinds, particularly in Europe, coming from the European Union, who is now the largest issuer of sustainability bonds and is on its way to be the largest issuer of green bonds. And of course, they source the expenditures from the European countries, which limits the capacity from a European sovereign to issue a green bond. So,
thank you so much, Myriam. And one last quick question for Lee. Against the significant appreciation of the US dollar compared to other currencies, can you comment a little bit on the impact that this is having on global markets, especially emerging markets, and maybe to be a little more specific about markets like Turkey, which are neighboring to Greece and a little more relevant? And I think this will be the last question, sorry, for the rest of the panel, since we're under time pressure.
Big build-up for me to finish well, then. Thanks. Listen, maybe I won't pick out individual EM countries or maybe EM at all. I think if you entered into 2022 with a business model or a solvent financing plan that relied on a plentiful supply of cheap dollars or low rates or low discounting rates, then you were in for a bumpy ride. We knew that. If you had an unhedged dollar position, you were definitely in for a very bumpy ride. As was said earlier on, cost of money has changed dramatically, and we can see that, not really my area of expertise, but you can see that in tech stocks, you can see that in areas of the property market, you can see it in EM, as you say. I think you have to remember the topic of this panel and this conference, it's not Greece. There was a temptation, I guess, a few years ago to take the dollar market and the obvious advantages that are there, but instead there was a very, very careful, prudent approach to nurture the investor base, which I talked about a little bit earlier on, nurture a very, very thorough risk management plan. And whilst you might get EM levels of growth, I think the Minister said that earlier on, you don't have the EM risks that come with it. So just to be fair to Turkey, they did manage to get a deal done just recently. The rates have changed. We'll see the medium-term impact of that. But that's the optimistic point that I think one of my colleagues here mentioned, is the markets that have repriced the most have been the ones that have been attracting attention. And we enter into next year not complacent. You know, you need to have advice, you need to have people that understand the depth of the market. I'm happy to give out my phone number afterwards, Barclays, by the way. But as long as you have that, you know, we've moved a long way this year, and it was important to do that, but it's done. The Fed can't do what it did this year again next year. So the risks are not away from us, but we do. I'll end on an optimistic note. You know, we have more than hope. We have some optimism there.
And the markets always look ahead, so we're hopeful as well. Thank you so much, everybody, for your inputs on this panel. And again, if there's no other questions, I think that's a wrap.